Well, Happy New Year, everyone. This is the Clear Vista Financial Perspectives January 2024 market update. Glad you've chosen to join us. I'm certified Kingdom Advisor Mark Trice. In the studio with me today is our fellow financial professional, Jesse Hamilton.
Hey, everybody. Welcome to the presentation.
Yeah, so this has been an eventful year, and we're going to talk about what we expect for 2024. But we want to get started with the presentation and make best use of your time. Today, we're going to discuss the long index performance, the year-long index performance for the past 12 months or so of 2023. That will be our usual indices that we share and talk about. We're going to talk about how much we still have left to go to recover from this bear market. And we'll talk about that. We'll talk about the current state of the economy, as well as a little bit about our outlook for 2024.
Right.
So we've got a new and improved way to interact with you on this webinar. You can send your questions to info@clearvistafinancial.com, info@clearvistafinancial.com, and we'll answer them at the end of the program, or you can also text us at the number there on the screen, 254-282-0495, 254-282-0495. And Jesse, I realized I left my phone where people can text me in my office unless you've got it on your phone. We can pull it up in just a minute.
Yeah, we can pull it up. But yeah, we'd love to talk to you and be able to answer your questions as best as possible. But let's get started, Mark.
Yeah, I'm going to go ahead and turn the camera off just so that we got a little more real estate to look at things. And Jesse, Go ahead and kick it off.
Great. So first here is the S&P 500. Once again, this is the 500 largest companies in the U.S. The index was plus 4.3% during the month of December. So we usually look at a month-long piece, but this is actually the entire year. And we're happy to see that it did continue through that resistance of the end of July and August. There's kind of a peak there in the middle of the year.
Circle that for everybody, Jesse.
Yeah, so we're glad to see that it broke through that. And it had quite a nice run during November and December. But it's kind of a piece of a bigger story I'll talk about in just a minute. The index did close the year 24% to the positive, but it was really a bumpy ride to get there. And it still has not reached its previous high. So here's kind of what happened throughout the year. We had a 9.2% January rally, and then we had a February and March sell-off of the same amount.
Yeah,
about 9%. And then we kind of moved sideways for a little bit, and then we had a pretty nice run up through March in the middle of the summer.
And that was where we run into the peak that I'm highlighting here on the screen, and the end of July. And the next 3 months really provided a big sell-off. I think it was more of a over about 12% is what the S&P 500 index at one point sold off.
That's very comfortably a mid-year correction.
It is.
We would call it.
It is. And so there was still risk on the table there. And what we were looking at there was we wanted to make sure that we were not going down below the lows that we saw in April and May in here, and certainly March numbers as well. And we wanted to make sure we avoided that. The market did, and I jumped ahead, the market did recover strongly starting in November. And we saw some consolidation at the end of November, and only to go up and finish the year strong.
That's right.
As Jesse said, the S&P was up over 4% in the month of December, and that's good. We're starting to see this area here in August was a critical breakout level, and we're glad to see that's moved on.
Yeah, so I wanted to obviously provide some perspective. That's why we call it the Perspectives program. This is the 2-year look back on the S&P 500. You can see how it's not reached the previous high from January of 2022. That's the blue line that I've drawn in there. It's always nice to look back and see that this index rose throughout the year, but it's very important to remember where we came from. Isn't that right?
Yeah, and we're still, this blue line up here at the top is a very significant level of resistance. That's the all-time high going back from 2022.
Right.
In January of 22. That's very significant. We were looking here, if I could draw a line I don't want to draw a line because it'll stay on every chart for me, but you see my highlighter going across over here. We had the high from March of 22, and then we had the high in July of 22 or 23. We were looking for that to break above that. It did finally in November, and that was a good sign that the market was beginning to turn.
That's right.
It takes some time, and we'll get into this in just a moment. It takes some time for the bear markets to recover. I've got a slide that will go into that in just a minute, but we have to look and see where we came from in order to see what we've got to do and what levels of resistance that we need to surpass here. Now, this is something that July high is really, we think, the next level of support for the market. We don't think that the market's going to retrace any further than that. If it does, it's quite normal to have a small correction like we did in October and certainly in March of this year, but we normally don't see but one or two of those a year.
That's right.
Okay.
So now we'll cover the NASDAQ index, which is what everybody wants to talk about in 2023. It's the tech heavy large cap index. Of course, these companies are highly leveraged. They're trading at over 200 times their earnings, some of these companies. But yeah, it closed plus 4.9% for December. But the year was extremely bullish, over 40% on this index. But we'll talk in a second about why that happened. You may remember us talking about the Magnificent Seven, which have pushed this index up over 2023. So really, out of the 100 stocks in this index, it's essentially just the performance of the largest seven.
And it really, the S&P was really the same way.
Yeah.
Those 7 stocks really led any rally throughout. We'll talk about why and how the market is recovering or not recovering in some future slides here. But those 7 companies is what pushed the index numbers up. So when you're listening to the news or the radio, that was something that was really 7 companies. And when those 7 companies were having a good day, the index had a good day. In the last few days of the first few days of 2024, those 7 companies have not had a good day, and thus the market's been down a couple of percentage points in the first 2 days of 2024.
So it's similar behavior to the S&P. That pullback from August to October was over 13%, so a little bit more volatile than the S&P.
Right.
But let's look back at 2 years, and if we want to talk about all this great growth, let's remember all the great loss that happened in 2022. So the NASDAQ is still over 11% from its previous high, and nobody wants to talk about that right now.
Well, and that's a significant level of resistance, is that previous high for the markets. Do we see that surpassing that? At some point, yes, but how long it'll take to surpass that may be the question. You find that at different levels of resistance, and I'm going back over here to the high in March of 2022 during the bear market decline, is also a level of resistance that the market had in July of this year.
Right.
And we surpassed that and finally broke above that in really in early December. So the market recovered a little bit. We've rolled over, but now we're starting to roll over again in that 2-year view. So it takes a while for these things to recover and bear markets to work themselves out.
If you're a passive investor, just holding the index over many years, you still have 11% less money than you did in 2021.
Yeah, and it's kind of confusing for people because and next time, Jesse, we'll have to put our slide in that we talk about the significance of losses and how much you have to gain. If an index loses 50% of its value in a bear market, you have to earn 100% return off of that low in order to get back to even. And that's why it takes some time. Let's look at the Russell index, Russell 2000 index.
Sure. So here's our small cap index, the Russell 2000. It had an extremely volatile 2023. It had a great December, plus 8.54%. And throughout the year, here's kind of what happened. We had an explosive January and then a steep sell-off in February, March. This index then moved sideways really for many months. And then it also rebounded some during the summer, only to fall even lower in August through October. So that sell-off from August to October mark was minus 18%.
Yeah, that's a significant sell-off. That's more than a correction there. That's almost putting it, if it weren't already in a bear market, it's
Yeah.
already putting it in, that would put it into a bear market. But notice
Mhm.
we've got these peaks in February and a peak in July, and that was a level of resistance that the market was facing, or the NASDAQ was facing during that time. We saw after the Fed meeting in November and December, that picked up quite a bit, still a long ways away from its all-time high,
Mhm.
but we are seeing improvement. The first few days of 2024, we've seen the sell-off there a little bit. NASDAQ, I think, is down about almost 3%
Yeah.
in the first 2 days of 2024.
But you'll notice right there at the end of October, just less than 90 days ago, this index was minus 7%.
For the year.
Yeah.
And so one thing I think is really interesting, though, Jesse, is let's look at the 2-year view. Well, we don't have that on here. I'll show it in a moment.
Yeah.
But the Russell 2000 index is still down over 20% from its all-time high in late 2021.
Yes, it is. And we'll talk in just a moment about what that means for the overall market breadth.
Okay.
So lastly, here's the long-term Treasury index. So this covers long-term bonds issued by the government. And it closed with a slight loss for the year, only because of November and December. If the year had ended in October, we'd be talking about a gradual decline all year and closing minus 17%.
And we're not showing the full picture here. The long-term Treasury index is down still over 35% from its peak in the pre-pandemic days.
Right.
And so this is really significant because a number of investors are holding anywhere from 30 to 50% bonds in their portfolio because they've been told that they're safe. What we saw last year, or in 2022, especially, and some more in 2023, we see that bonds and stocks were highly correlated, which is not typical. And we want to see that improve. We're seeing Treasury rates fall a little bit in the last few months, and that's why you see that upward tick in November and December on the long-term Treasury, but still a long way to go before the long-term Treasury market begins to improve.
That's right. So here's our brief slide on the indexes, if you're curious what they are.
Disclosures, right? Disclosures, S&P
right.
500. Let's go back and look at a couple of things, Jesse, because I think this is real interesting as we talk about the health and the breadth of the market.
Yeah, so here's what we talked about earlier. The green and red line is the S&P 500, and the blue line is the Russell 2000. So I've overlaid them on top of each other. And you can see how in 2021, the blue line was above the red-green line. And then what happened in 2022 is they kind of correlated. And as we made our way into 23, March, you can see a distinct change.
That's right. And this is really significant because in the history of the stock market in the US, whenever we've been in a bear market, which I still believe we are, whenever you're in a bear market, the rally out of the bottom is most typically led by small caps. Small cap companies, the index itself is the blue line here. You can even see going back into 2021 that small caps were leading the way.
Right.
All right. That's really still a post-pandemic recovery of that small bear market that we had in 2020. This is real significant. Now the small cap indexes really just moved sideways in 2021, which means that they weren't really going anywhere. Yeah, but in order for us to see this broad-based rally, small cap companies need to lead the way. And so we see this divergence between the two indexes, which tells us there's still some weakness in the overall health of the market. I've got another slide in a moment that I'll show that. That's starting to shift, but one of two things have to happen here. Small caps have to catch up to large caps, or large caps have to decline back down to the small cap level. We want to see that convergence of these things happen again. We want to see the blue line move above the S&P red and green line there with that. That's real important. We hope this trend continues. In other words, we hope they still continue to converge, but it's a really tough process. We want the small cap companies to make that incremental shift into the lead.
Yeah.
And we've got another way to explain that right now. And we're starting to see that shift in the last 2 months, Jesse.
That's right.
Gradually.
So here's a comparison between large cap and small cap. And to make it simple, when the black line is trending up, large caps are winning. And when the black line is trending down, small caps are winning. So notice that most of 2023, we saw the black line trending up, meaning that the large caps are in the driver's seat. And then
that's those magnificent, those seven
right.
companies really driving things.
So then in November, this trend shifted. You can see that peak there in November, and we'll continue, if both indexes can generally continue up, and this comparison shows the small caps winning, we will see a broad-based rally in the future. We would love to see that.
Yeah, that's right. And so it's real important and we monitor this on a daily basis.
Yeah.
To see where that's going.
So here's the S&P 500, but equal weight. So it kind of gives each of the 500 companies a vote. And this data is a little bit older. In the month of December, we broke through that box that I've drawn, which is very positive, but then very quickly we retraced back into it.
Yeah.
So we're still struggling to break out of this box.
And the equal weighted index is very important because it's more influenced by every company, not just the largest.
Yeah.
In this case, we were talking about the Magnificent Seven, the largest 7 companies in that. Think of it as a comparison between the U.S. House, which is very much weighted based on the population of the state,
yeah,
versus the Senate. The Senate would be the equal weighted index of the S&P 500, where every state gets 2 senators. In this case, every S&P 500 gets an equal weight or equal vote in that. And we saw this basically move sideways in 2022. We have not recovered fully to those highs at the end of 2021. So we still need to see that change to where the equal weighted index begins to outperform the large cap index. I think that's coming. It's just going to be a bumpy ride there.
Yeah. So here's a chart that shows the percentage of stocks that are above their 200-day moving average. And generally that 200-day moving average is seen as a universal sign of strength and bullishness. But I want to show here and point out how quickly we went from 24% to 65% of stocks being bullish across 2 months. That's extremely dramatic.
Yes, and when we see that, what this means is that at the end of October, 76% of all the companies on the stock market were in a bearish trend. They were in a downward trend. And now we've seen that reverse to where we're right around 60% of the stocks are in a bullish trend. That's good news. We hope that continues on upward. Right now, we're still in this state of flux. We had some retracement in the last week or so of the year and the first couple of days of 2024. But these are all positive signs that we hope will continue.
Yeah, we'll take what we can get as far as bullishness, but we want to see this a little bit less volatile. So here's a little bit of a busy chart. I apologize for that, but it shows the normalized returns of several different types of investments. We have the S&P 500, we have some gold, oil, treasuries, and then we also have the consumer price index, all since the close of 2021.
And you can see a number of different things here. Basically, the S&P 500 is unchanged in that period of time. It's still slightly below the all-time high of 22, but it's basically unchanged. Oil and bonds are down 10%-ish, if you will. Gold and the consumer price index, which is our measurement of inflation, are up over 10%.
Yeah.
Now, investors that were looking to diversify and wait over the last 24 months have seen very little return on their investment, while their household inflation's up more than double digits.
Yeah.
So let's go ahead and move on to the macro discussion of the economy, if you will. Just remember, send in your questions to info@clearvistafinancial.com or text us at 254-282-0495. And we'll get to them on the program today or within 24 hours of that. So
what happened in December?
Well, in December, there was a little meeting with the Federal Reserve. The Fed held its benchmark for a second time. They did that in November and actually in September too. For a third time. They held it steady at this 22-year high on that day, and it offered every reason to think that the most recent increase this past July probably marked the end of the most aggressive cycle hikes in 4 decades. At the press conference, we watched this. This is a common occurrence, if you will, in our office. We want to see and interpret every word that the Federal Reserve Chairman says. The statement that he makes at the front is not that big of a deal. It's released about an hour before the press conference.
Right, he just reads it.
The focus is on the questions that come from the reporter pool. And there's really only 2 reporters that we're paying attention to. Most of them, I think they just graduated college and don't know what the economy is. But a few of them are asked very pointed questions that can really reveal a lot of things about the state of the economy, also the thinking that the Federal Reserve Board is going on to there. So they're really focused on possibly not hanging on to higher interest rates for a long time. That is a big shift. And I'll show you here on the next slide. These are quotes from a couple of articles. On the 1st of December, the Fed chairman says it's way too premature to cut rates, right? But
that's one view.
One view. But by the 13th of December, which is the press conference.
Yeah, the main event.
The headline read, Fed policymakers discuss timeline to start rate cuts. Now, we've started looking at this a little further. Yesterday, we just had the minutes of that meeting come out. And we do think that the Fed is done raising rates for now and may not raise them again. But the timeline for when to cut rates, it's much further out. There was not any notes and really there was no discussion in the meeting in December to determine where and when they were thinking about that. All we have,
contrary to the headline here.
Exactly. But that's the interpretation that the investors in the market took.
Yeah.
And the market took off a little bit more for another week or so.
That's why we saw 4% in December.
Right. We didn't have the Santa Claus rally that we had hoped for in between Christmas and New Year's, but we did see some movement up. And post that press conference, we saw that because people said, "Oh, they're going to cut rates." In some cases, some predictions were 4 times next year,
right, for
a full 1.25%. Well, the minutes today say that's not such a positive or a reality, if you will. Let me look here on a couple other things here. This is the history of Fed rate cycles. Now, the steepest one yet is the red line, and that's what we've been going through right now. Okay, we've been going through that, and you can see how fast, relative to other recessions or tightening cycles that the Fed involved in, they're much more gradual. And what we're trying to avoid is you see there in the late 1970s, early 1980s, the big black line, rates were much higher, but we've never seen a path of raising the Fed overnight funds rate so fast in the last 18 months. And so this is the current cycle, and we think it stopped. We're not going to raise it anymore, but all we have to do is go back to the mid-1980s, early 1980s, when the Fed at that time cut rates too quickly, inflation took off again, and they had to raise rates even further. And so, it's a little premature to determine when the Fed will cut rates. We're also, from a market perspective, we have to be careful with that because usually there is a decline in the stock market when the Fed actually does start cutting rates. And I know that sounds counterintuitive, but that's the past history of rate cuts in the U.S.
So here's the same chart, but in a sequential timeline, kind of shows the comparison of the rates. And we had mentioned 22-year high. You can see how the current rate is higher than all the other, going back all the way to 2000. So that's where we got that number from. It really shows how the Fed has been manipulating the market each time the economy enters some sort of crisis. And this chart generally inversely correlates to bull and bear market conditions.
And we note here that at no time in our history in America has the Federal Reserve, the federal government, intervened and influenced the stock market.
Yeah.
And the last 15 years have been heavily propped up by the Federal Reserve, by the government, such that we think that's kind of manipulation. But that's what's going on right now, and we will continue to probably see that for some time.
Right.
So how does that relate to the Treasury yield overall? Okay, at the end of 2023, we were seeing the 30-year Treasuries, right around 4%. That's a little bit higher than it's been. The short-term Treasuries, the 1 month, 3 month, were still above 5. Just remember, when we see this inverted position in the yield curve, normally a yield curve, I'm going to try to draw this. Normally, a yield curve is the exact opposite of what you're seeing on the screen. When this position happens and this situation happens, it is always led to, it's a precursor to a recession happening.
Right.
Now, there's some that still think that we're going to have a soft landing, but a soft landing is still a recession.
Just a mild recession.
Treasury Secretary Janet Yellen, and I've sat in a room with her before. I had a couple of classes with her actually long time ago. And she's basically, according to her language, she's basically saying we're still likely to have a mild recession. So that's what she means by soft.
Yeah.
But considering all this, we still think rates have fallen in the last couple of months. How much more they'll fall, I don't know. I think they'll tick up a little bit. I was talking to someone today that just locked in a 30-year mortgage below 6%.
Wow,
5.99%.
Must have good credit.
Yeah, but they must have good credit. But it's related, the 10-year Treasury, which is on here down at the bottom, it's still above 3.8 or so percent, below 4 right now.
It did drop a little below 4, but it's still around 3.85.
Yeah. And so we're waiting, we're hoping to see some more clarity, more direction coming out of the Federal Reserve's meeting on January 31st, where they'll make an interest rate decision. I don't think they're going to cut it this month.
I don't either.
And I think that the probability of a cut in March has been pushed out till May. So it may be, towards the middle of the year before they even consider doing cuts for 2024.
Right.
Just remember that prior to the December 13th meeting, Federal Reserve folks in November were saying, we're not going to cut rates till 2025. They need to see some things happen with unemployment and job openings and things and other things. Then, of course, inflation to continue to cool. Inflation's still going up, folks.
Yeah.
Inflation is still going up, and maybe not at the same pace as it has in past years, but it's still going up. And the Fed is going to continue to watch that as it influences their monetary policy.
Yeah. Let's talk about the housing market for a second. We've had several clients reach out to us with advice on housing, but we always like to inform people what's going on. New single-family homes, so new builds, declined 12.2% in November, and that was below the consensus. And the month supply of new homes increased to 9.2%, but sales are slightly up from a year ago. And
that supply number is really significant.
Yes,
okay.
it is.
In a past life, I was a realtor, and we would look at that month supply to know how tight the housing market is.
Yeah.
When the months of supply goes below 3%, we say the housing market is extremely tight. But now it's creeped up above 9%, meaning that it might take, if no one else put their home for sale and no builder built a new home, there are 9 months of supply available in the market for potential buyers to purchase a home.
It was
now,
7.9 a month earlier.
That's right. And so we see that lengthening out. When this time last year, we saw that around the 3 to 4%, I believe.
Yeah.
And that was a much tighter market, because you're seeing now a lot of people that may have a 2.5 or a 2.9% rate mortgage interest don't want to sell their property.
Of course they don't.
Yeah, because of the good rate. They're having to pay 6%, or at one point in early December, it was 7%.
Yep.
For a 30-year mortgage.
People could easily double their monthly payment and not get anywhere near double the house.
That's right. So, we're seeing this decline of homes, existing home sales, or single family homes in November. That's significant, and we're seeing that continue to decline. That could be just because of the rising interest rates in the previous months. I think we're beginning to see a reversal of that, where we'll see that increase over the coming months.
Right. So here's the next slide is
Existing home sales. Right. I got ahead of myself, didn't I?
Yeah. So these are homes that have been built and you're just buying and selling them. Those sales did increase 0.8% in November. That beat the consensus. So that was 3.7 million, but sales are down 7.3% versus a year ago.
All right. So situation's not improving, but I still think it's because more people are holding on to their existing properties.
Yeah.
And so how does this all impact you? Well, there's a number of different things that we look at. There's so much conflicting data right now.
Yeah, even between housing, we saw two different reports, right?
That's right. So we don't have a crystal ball to tell you what's going to happen in the future, but we do think that some of these conditions have led to recession every other time in history. I don't think it's going to be a bad recession. I think it's a mild recession. So this is why you hear Janet Yellen saying a soft landing.
Right.
That's political speak for it's a recession, but it ain't gonna be that bad.
Right.
So we'll look at these things, and we try to balance all these things. Now, I know this is election year. We get lots of questions, Jesse, from clients about, okay, it's a presidential election, I should go hide under a rock. And we're actually going to do a full-blown presentation about years, but we keep hearing about Bidenomics and how good the economy is under the current administration. Now, this is not to support or disapprove of your favorite candidate. This is just what's happened during that time. So consumer prices up 17%, gas prices up 28%, credit card debt has risen dramatically in the last year, up 40%.
We talked about that in the previous episode or show where
right.
The money supply that people have is dramatically down.
So the real hourly wages have gone down 2.8%. So if prices are increasing, our wages are decreasing.
That's right.
That creates a situation where we're going to take on more debt. We're not going to spend as less, especially if unemployment keeps going up. And a number of economists believe that in order for the Fed to reach its target goals, unemployment is going to rise to around 4.1%. Right now, it's less than 3, I think what it is.
Yep.
Well, it may be 3.8. I don't have the latest data. That should be coming out tomorrow, actually.
So Bidenomics has really affected households during the current
administration. And they gave that name to themselves, which is kind of a bad idea. But just in this administration, these are the changes that have taken place.
Right.
The most concerning thing, of course, is the 17% increase in consumer prices with wages dropping. That's what we're looking at.
Yeah. We came across this article in the Wall Street Journal the other day about adjusting the holdings in your 401k. We've talked about a few months ago about the lacking potential of a 60-40 or maybe a target date type fund moving forward. But this was an interesting read about how it could or could not benefit you to make more changes in your 401k.
Yeah, it was a study by BlackRock that put it out there. They presented an interesting experiment, if you will. If you had perfect foresight and you could shift your stock investments once or twice a year toward the best performing sector, how much would you gain? Well, it turns out much more than before. And that's because the typical 60-40, 60% stocks, 40% bonds is not working the way that it did 20 years ago.
Right.
And we, of course, we use momentum. And nobody has the superpower of predicting. That's why we say we don't have a crystal ball. We don't know what's going to happen today or tomorrow. We only look at the data. But if you go back and look in the past, that momentum strategy, if you will, of switching into whatever sector previously did best, which doesn't require a lot of superpowers or anything,
right,
that has really outperformed index investing in the recent couple of years.
So does that mean you should make constant changes in your 401k?
Absolutely not. Absolutely not. But you should be studying your 401k from time to time to see if certain things are underperforming.
Yeah.
The problem that we see with the most 401k plans is that they offer very limited choices. They offer a bunch of large cap stock investments.
Right. You might have 8 or 9 funds total.
Just a few, the mid cap and small cap, a little bit of international, and then the rest is bond options. And usually there's 2.
I was working on a really good one the other day, and I think it had 14.
14 options? Okay.
Yeah.
Okay. Now some have just a crazy amount, which is not very bright on the plan designers that are sponsoring that. But if you were invested in a typical portfolio this year that, or 401k portfolio that had majority of large cap options, you probably did okay this year. You actually had some good gains. But the reality is that may be ending. We don't have a crystal ball, but we don't know that the Magnificent Seven will continue to lead in the coming years.
And if you're confused about this, talk to your advisor about it. Develop a plan. And if you don't have one, give us a call. We'll do a free consultation with you.
Yeah, we can absolutely talk to you about those things. So this is a kind of an interesting factoid we saw from Carson Investment Research. It looked back at the historical data for bullish runs, and we think we're going into potentially, it may take some time to work itself out.
Yeah.
We think we're going into a bullish period in the markets. So it looked back at historical data for bullish runs over 10% in November and December. And then what happened the year after that? You can see that the data is almost fully positive, meaning that markets that had a good end of the year typically have behaved bullishly after that strong November, December.
Right. Lots of green on that chart.
That's right. Now, 2020 is an exception, right? 2020 is an exception when no one could have predicted that there was going to be this little thing called the coronavirus take over the world. Does that mean that we should really jump in with both feet and expect 20% returns? Absolutely not. But it does give some additional positive signs as we go into the new year and whether or not will continue. Now, there's also another adage and some study and research has been done that shows if the month of January is poor, and in the first 2 days of the month, trading days of the month, we've had a poorer performance. If the entire month is negative, that leads to potentially a not a bearish, but a more negative view of the rest of the year. But these are all just historical studies looking at there's a stock market almanac that we look at sometimes to see history and things. History sometimes has a tendency to repeat itself, but it doesn't mean that that's what's going to happen. We've got here a mix of different scenarios. I think that we've got a little cross comparison of what happened in the 1960s, the late 1960s, also in the post-World War II era, where there was so much government intervention, so much demand created by the federal government because of the industry needed for World War II to fight a war on 2 fronts, that we're trying to undo all that, right? In that period of time. So it was kind of bumpy. I think the same thing is going on here. We had unprecedented amount of stimulus that was put into the economy post-pandemic, and you've got to figure out how to unwind all that stuff. And it's going to take some time with that. And speaking of time, Jesse, we put this in our letter to clients back in October, but it really is kind of a history of how long it takes markets to work themselves out of a bear market period. And the time to get back. A lot of people forget these things, but going back to the 2000s, the NASDAQ was down 77% at its low.
Very painful.
I know where the high was because I know, what I was doing at that time, and I know what was going on. That was in March of 2000, and it took a good 2 years for the bottom to be found, all the way into September of 2022. But it took over 16 years to get back to where it was on March the 9th, 2000. That was the high.
They nicknamed that kind of the lost decade, where you didn't really gain anything over more than 10
more than a
years.
decade. It was 16 years with that. Same thing was true in the great financial crisis in 07 to 09. The S&P was down 56%. It took over 5 years for that to recover to its point. Now, just because we're close on the S&P now to reaching that high doesn't mean that it's going to surpass it any day now. We don't know how long this current bear market will take to recover fully. Right now, we're going into the second year of that recovery. and we still got some time to go, I think. So this is, if you got the time to wait and you've got a 30-year investment horizon, it's okay. You stomach the ride. But we prefer to use technical analysis and active risk management. There's no system of money management that's perfect, but we feel that our approach helps mitigate those losses and navigate the volatile market cycles and things.
Yeah.
That's what the article in the Wall Street Journal that we were talking about just a minute ago about your 401k is using momentum. And that's a fundamental part of how we manage client money. So that's just a kind of a history lesson there on that. So everyone wants to know. We don't like the phrase here at Clear Vista Financial, this time's different, because it's oftentimes used to say, to justify why we should ignore market and economic data that are flashing warning signs.
We don't like to use it, but it's very true.
The thing we have to look at here, going from the end of October through the end of the year, we started seeing some very positive signs in the market, in the economy, and we think that future is bright. Is there more time and potentially ups and downs that are going to happen before the market recovers fully? Absolutely. But that's why we use this active risk management and technical analysis to avoid panic or making decisions based on headlines.
Yes.
I mean, you read the headlines and it's like, I quit reading the headlines.
Well, we just proved in a few slides ago that they can flip-flop in 13 days.
Absolutely. And it kind of depends on the reporter and what their view is. I don't know if you know this, but most major newspapers have a separate person from the reporter actually write the headline.
Yeah.
There's a dedicated person to write headlines. And a lot of times the headline writer doesn't understand anything that the Federal Reserve Chairman just said.
Yeah.
So we think there's still some time before the Fed cuts rates. We still think that, and history shows, and we'll share this next month on our update, history shows that when the Fed does start cutting rates, it actually creates more volatility in the markets.
Right.
Now, long term, it's good for the markets. Short run creates much more volatility in the markets. All right. So, hey, we're into 2024. We encourage you to take action in your financial journey. We're always here for you to help navigate this world of complex financial planning and investment management and things. It's something that we pride ourselves on doing it differently, whether it's a recession, a bull market, or anything in between. Just let us know if we can help. If you have questions about your portfolio or your financial plan, give us a call. We've got those numbers on the screen earlier, 254-282-0495. You can text us or call us or send us an email at info@clearvistafinancial.com. Invest in your financial future. Look at your statements. Talk about your financial plan with your advisor. And if you don't have one, we can certainly help you find one.
Yeah,
if not, help you as well. So I'm going to look real quick, Jesse, on the board here to see if there are any questions.
Okay.
Or anything. Let's see here. I don't see anything on the text line.
If it comes up later or you're watching this in a few days or a few weeks, go ahead and send that text. We'll respond.
Absolutely. Let's give those numbers again one more time.
So the text line is 254-282-0495.
All right, folks. This is the January market update, Clear Vista Financial, our perspectives and things. Thank you for joining us and have a wonderful 2024.